and I like the management where they are returning 50% of the profits to shareholders via dividends, and they were also doing an aggressive buyback last year. It seemed like a steady business. Is out of favor. It probably will remain out of favor for a while, but I think shareholders will do well as they're getting paid, a good dividend yield about 7% or so, and business is profitable, debt is reasonable. The dividend payout is about 50–55%. It seems like the first priority is maintaining the dividend, and the buybacks which was done this last year financial year was not something that is going to be recurring or may not be at to the level it was. I think they probably bought 7–8% last year. That may come down, I mean, if they have to, but the dividend is the priority for them. At 50%, I think it should stay there, if not grow. And they have grown it. If I see the last 5 years, they have grown dividends by 10% a year on average. So they have been returning money to shareholders consistently. It's not like based on 1 year track record of dividends. It has a leadership position in most of the retail businesses that it does. Like it's the leading position in it sells bicycles. It has leading business like 25% market share. That is one of the things. And then they obviously sell some car parts, more for individuals, not for the garages or the repair guys. But they do that, and that's pretty stable, steady business, and they have good margins there. It's growing steadily, and they have a service element as well, which a lot of competitors may not have, like a Tesco or the Walmarts in UK, or they have stores there. So they will also fit some of the parts for you. So that is an element which is attractive, and that's growing as well. So people will buy some parts from them and get them to fix it for them instead of doing it themselves. So there is that service element which gives them some differentiation. So they also repair bicycles. They sell service plans for the bicycle repair and parts. So they have some of those elements which are really attractive. And then they've bought a business in 2010 for auto repair. So they've bought about 240–250 car repair centers, which is only 10% of their business right now. And they have only 1% market share in the UK. I think the UK is it's a pretty big market for auto repair, and they are planning to grow that business by opening 30 auto repair service centers a year. So there is that will grow eventually over 5 years. I think that business will do well. So there is some room to grow. They have a steady business, stable cash flows, shareholder friendly management, because they pay out the dividends, they do buybacks, and the capex is relatively low. Even for a new center that they are opening, there's a 3 to 4 year payback on those centers. It's pretty low capex to open those centers.